Hello and welcome to today's daily analysis for the 14th February 2024. So for today, the US dollar strengthened, reaching a high of 104.96 on the dollar index, the highest since mid-November, boosted by January's consumer price index results that delayed expectations for the Fed's easing cycle. The upcoming economic reports on the producer price index and retail sales are anticipated to provide further support to the dollar. Despite recent volatility, the RSI and moving average convergence divergence suggest a positive overall trend, with the dollar currently hovering above the 100-day and 200-day moving average, indicating a strong bullish outlook for the outterm. Investors are closely monitoring the US dollar movements, particularly after Fed Jerome Powell remarks in early February ruling out a rate cut in March. The market is awaiting key economic data such as the producer price index and retail sales to gauge the economy's performance and the Fed's future stance on interest rates. Despite some short term selling pressure, the dollar's resilience is evident in the positive signals from the RSI and MACD, supporting an overall positive trend. Upside potential is highlighted at 105 and 105.76, while downside risks are mitigated by the 100-day moving average at 104.25 and the provisional 200-day moving average at 103.64. And then for our WTI crude oil, the price is retreated as OPEC monthly report revealed discord and non-compliance amongst members, led by Iraq resistance to proposed production cuts. Despite testing $78, WTI faced challenges in maintaining bullish momentum amid geopolitical tensions and record high US crude production. The market remained range bound, hovering above the 200-day moving average at $77.3, resistance at 78, and potential support at 75.13, 74.07, and 73.36. The OPEC is having trouble because of the US is producing a lot more oil than agreed. The WTI crude oil, which went up by 7% from last week's low, is finding it hard to go past $78 despite trying. Geopolitical issues, like the Israel saying no to a quick peace deal, are keeping the oil prices high. The long-term signs suggest it's tough for oil prices, staying in a range and leaning towards going down. If it goes above 77.3, it might go to 79.13, while 75.13 is a strong support. The gold prices face increased selling pressure, dropping below the crucial $2,000, leaving as concerns over the recovering US economy and potential delayed rate cuts heightened. The US dollar index consolidated around 104.12, while higher US Treasury yields add the downward pressure. China's financial markets were closed for the Lunar New Year, and its inflation experienced the largest decline in 15 years, hinting a potential deflation. But despite this, the gold losses are expected to be contained due to additional stimulus measures from Chinese authorities. Currently hovering at around 2016.50, the lower support line of a symmetrical triangle pattern, and 2015.5, the 61.8% Fibonacci retracement. Gold's next move depend on breaking either above 2000 or below the 100-day moving average at 1.989, with further support at 1978.6. The AUD USD experienced a notable decline, breaking below the 0.65 support level and signaling a potential bearish trend in the short term. Despite positive Australian consumer confidence data, the Australian dollar faced downward pressure due to slowing inflation, leading to perceptions that the Reserve Bank of Australia has completed its monetary tightening cycle. The currency pair is currently hovering around 0.653, still in proximity to the 20-day moving average 0.6549 and 0.657 level 50% Fibonacci retracement. Direct resistance is at 0.64, while 0.6411 at 76.4% Fibonacci retracement, and psychological level of 0.64 can serve as immediate support. A break below the latter may push AUD USD towards the November 10 low of 0.6338. On the upside, attention is on 0.65 and 0.6549, 20-day moving average. Today's suggested strategy involves shorting the Australian dollar below 0.648, stop loss at 0.65, target levels at 0.643 and 0.642. The British pound faced a decline in early US trading, dropping below the 1.26 level due to a strengthened dollar fueled by robust January inflation data. The pair is consolidating above 1.26 in early Asian trade, with the market awaiting for the upcoming release for the UK's Consumer Price Index (CPI) data. Federal Reserve Chairman Jerome Powell's recent remarks suggest a delay in potential interest rate cuts until May or June, contingent on further evidence of inflation. Despite optimism from the Bank of England Governor Andrew Bailey about the UK economy, policymakers are considering a shift from tightening to potentially cutting interest rates due to a recent drop in UK inflation. The pound has fallen below the crucial 1.26 support and a breach of 1.2572 last Thursday low and 1.2562 200-day moving average could lead to a retest of the previous low at 1.2518 or even 1.2485, 23.6% Fibonacci retracement level. The short-term bullish momentum may face challenges breaking above 1.27 and 1.272. 61.8% Fibonacci rebound level, with the higher target at the December high of 1.2828. For the Japan yen, surged to a 3-month high of 150.88 following the Bureau of Labor Statistics reports on the US inflation, which, although slow, remained above 3%. The pair traded at 150.78, up 0.96% during early Asian trade. The uncertainty around the timeline for rate cuts has led to consolidation in the US dollar, with Federal Reserve officials awaiting more evidence of sustainable inflation before considering rate adjustments. The dovish comments from the Bank of Japan suggest that even the negative interest rates and loose financial conditions will persist, potentially weakening the yen and providing support for USD Japan yen. The pair is consolidating after breaking key resistance at 150, with further gains expected towards November 16, high of 151.38, and the November 13 high of 151.91. Conversely, a move below 150 may lead to a test of 148.37, 10-day moving average, and further support at 147.45. 61.8% Fibonacci retracement, and 147.49, 25-week moving average. And then lastly, for the euro, it fell 0.9% to a 3-month low near 1.07 on Tuesday after US Consumer Price Index inflation exceeded market expectations. The money markets are wary of the Fed's interest rate cuts as the US inflation levels become stickier than inflation expectations. The euro eased back at the start of the new week, dragged down by broad dollar strength, which gained slightly on the back of the rising US Treasury yields. Price action on Monday was less than impressive as many traders remain on the sidelines, waiting for the new catalyst that could spark more meaningful moves. The euro tested at 1.08, but broad market flows remained tepid, with a lackluster start to a new trading week. Less data was released on Monday. The Eurozone is due to release gross domestic product data on Wednesday, and European Central Bank President will speak on Thursday. Separately, the United States released US retail sales on Thursday. The euro approached resistance at 1.0795 on Monday, but later reversed course. If the bulls can hold on to the 1.068, 75-day moving average, and 1.07 market psychological level this week and are confirmed by the market, it may trigger a rise in price at 1.0795 Monday high and 1.08 market psychological level, and May recent rally is seen towards the 200-day moving average and trend line resistance at 1.083. Attention will be turned on in the 1.09 mark. But if the currency pair falls below 1.07, which is the round number mark, and 1.068, it will be seen 1.0643, 23%, 23.6% Fibonacci rebound level from 1.1275 to 1.0448 level, and we'll test the 1.06 area level downwards. And that is it for today. Thank you for watching.